In my experience, when we first start working together as buyer and agent, and we go through a consultation, usually one of the first few questions is, what happens when I write an offer and something's not quite right? Or how is my, I understand I need to make a good faith deposit. How is that good faith deposit protected? At what point do I lose my money? That's usually a really big concern for clients. And so what I want to cover in this video is the 3 outs that are in all real estate contracts. Assuming that you're a buyer who's using a down payment, cash down payment, and financing, your contract has a standard position, let's call it, with 3 outs. They are an inspection contingency. This has to do with basically the physical condition of the property, but it's not limited to that. It could be your investigation, overall neighborhood, safety, schools, or whatever you want to investigate. So you have an investigation contingency. Your second contingency is going to be an appraisal contingency. This contingency means that on face value that the property needs to appraise for the offer price agreed to in the purchase agreement. And then the third out is your loan contingency. This means that you've met all of the requirements the lender has for being approved for the loan. The appraisal is complete and is at value or is at the contract price. You've provided them all the information and they're basically ready to give you the loan at that point. So these are the 3 outs that every buyer has or every contract has as standard. And each of these outs, it protects the good faith deposit. So for example, let's say you write an offer, it gets accepted. Then you do some inspections in the property, find some things you're not comfortable with. Whether you decide to negotiate that or not, you could simply exercise the investigation contingency, submit a cancellation in writing to the other party, the seller. And once they agree to that, that would cancel the contract, and then your good faith deposit would return back to you. You'd go back to searching for a different home and be on your way. Alternatively, you may go into a contract, you may investigate the property, you're happy with all of that, you remove the inspection contingency. However, when the appraisal takes place, let's say you were in contract at $800,000. Unfortunately, the home appraises for $775,000. You went back to the seller to renegotiate to a lower price or even a middle ground on price. They weren't willing to do that. Same process. You submit a cancellation in writing. They accept that. Your deposit comes back to you and you move on to looking for another property. And so forth with the loan. I would say generally that the investigation contingency is much more broad than either a appraisal contingency or a loan contingency. Those are very specific actions related to those contingencies, whereas the investigation contingency is very, very broad. And each of these contingencies, they tend to run on different deadlines, but simultaneously running. And another sort of like nuance about contingencies that comes up frequently is, let's say, for example, you wrote an offer with a 10-day investigation contingency. Well, what happens on 10-day? If on day 10, I don't remove my contingency or cancel the contract, does the contract, sort of blow up and I lose my money? Well, no, actually, in fact, the contract has provisions about what should happen if day 10 comes and goes and who's responsible for doing what. But in simplest terms, it could very well just extend on if, for example, the seller doesn't enforce that timeline. This is sort of a nuance about the contract, but something that people do get a little bit nervous about. I have 10 days and day 10's here and, I don't want this thing to explode on me, but it doesn't really explode. It's upon the seller to enforce the timeline of the contract and for you to be performing as a buyer inside of the timeline of the contract. So, yeah, what's interesting about real estate is the market is constantly adjusting. And so, let's say during the low interest rates or COVID real estate market cycle, the market, there was way more demand than there were homes available for sale. So you had a really fast-paced market. This was forcing buyers to have to remove contingencies, even inspection contingencies, which was really before then pretty rare. Since interest rates have gone up and demand has come down quite a bit, the market is moving at more of a normal, regular pace. And so we're seeing most all contingencies back in contracts on a deal to deal basis, or just overall, you're seeing basically buyers in the Sacramento area have inspection contingencies and appraisal contingencies. And like it was in the past, there's always a really desirable property where there are a number of offers on that property. And you will start to see a contingency or two be removed. And those tend to be an appraisal contingency and or a loan contingency, and much less often an inspection contingency or all contingencies. And so that is, I would say, in today's market, 2024, removing the inspection contingency is much more an exception than, say, in 2020, 2021, early part of 22, where that was much more regular. I wouldn't say it was 100% of the market, but it was pretty frequent back then. But now I'd say the market's kind of normalized from Sacramento. And of course, these things are different in different regions. So if you're, let's say you're coming from the Bay Area and you're relocating to Sacramento, if you did any kind of searching in the Bay Area, let's call it San Francisco, the practice there is that the seller gets all the inspections completed in advance, completes all disclosures in advance, and provides this disclosure report package in advance of buyers writing, or even the property going on the market, let alone buyers writing an offer. So the expectation in those markets is that the buyer reviews all of this information and writes an offer without contingencies. And so sometimes Bay Area buyers will come to Sacramento thinking that might still be the case here, but it's actually not. And this is also true in parts of Southern California, depending on exactly where you're at. Generically, probably the closer you are to, LA proper, the more frequently that's happening. But different regions, even within the state, have slightly different customs, let's call them. Justin Vierra here, guiding you through all the real estate nuances and complexities in the Sacramento market. Love to be your resource. And if not, see you on the next video.